This is part 4 of Oroco Resources video series. In part 3 we talked about Santa Thomas as a property, how big it is, and things like that. This video we're going to talk about grade, some economics, and some valuation estimates, just to give you an idea of what we're dealing with. So again, here in front of you you have a map of Santa Thomas, and in part 3 you learned that the amount of copper in the ground can be anywhere between 6 billion pounds to 14 billion pounds, and the answers differ because of the nature of the historical drilling. Now, one of the ways that people like to value deposits like this is how much a major would pay per pound of copper in the ground. And while there are some drawbacks to this method, I still want to go through it just so that I can give you an idea of what we're talking about. In front of you have a spreadsheet, and let's say we have two different metrics. Number of copper pounds in the ground, 6 billion, which is what Oracle has in the presentation as a very conservative number, and then some other people said 10 billion. So let's just use these numbers for right now. People like to say that these kinds of assets could be acquired for anywhere between 3 cents to 10 cents per pound. And just for a reference, right now the price of copper is about $2.60 per pound. So a major paying 3 cents to 10 cents per pound, you can kind of have a reference of how a small percentage that would be in relation to the price of copper. For this illustration purposes, let's use 5 cents. So let's say I enter 5 cents here. That would give me a valuation of 300 million. And if I use a 5 cents on 100 billion pounds of copper, that would give me a valuation of 500 million. Now, while people obviously like to stay conservative and everything, I'm going to use 10 billion pounds of copper. And I'm going to now show you why I'm going to use this number versus 6 billion. Well, number one, the regulators are not telling me what I can use and what I cannot use, so I can do whatever I want. But, let's be a little bit more diligent about it. If we go back to the Oracle's presentation and we scroll down to page number 11, notice this wording here. Herein, inferred is included in waste for purposes of the historical estimate of waste and a modified stripping ratio. What does this mean? Well, first of all, if you watched my Mining 101 videos or you read some of my books, you should already understand what inferred means. And just to kind of summarize this here, when you have a resource and you have a bunch of holes drilled through it, when the results come out, you can classify your resource into measured, indicated, or inferred. And this number that the company gave, which was right here, 821.7 million tons, that translated into the 6 billion pounds of copper, that is only measured and indicated. Inferred is treated as waste. So that's why that 6 billion pounds that the company has is unrealistically low, because the difference between measured and indicated versus inferred is that the holes that were drilled into the ground to arrive at measured and indicated are spaced closer together than the holes that were drilled for inferred. So in order to take the inferred and transfer it to measured and indicated, and I'm not saying all of the inferred will be transferred, but some of it will be transferred, it would require more holes that are closely spaced. If we look at the total number of tons included in the waste and inferred, we have 2 billion tons. Okay, and let's say that a quarter of it gets upgraded to the measured and indicated, then you could easily see this number going from 800 to 1,200. So that's an increase of about 50%. If I took 6 billion and I increased it by 50%, I can almost get to 10 million. I get it. I get 9, right? But there's one other reason why Oroco's number is, unreasonably low. Well, we can see here that some of these holes, well, actually 50% of the holes that were drilled ended in ore. Here's what it means. The difference between waste and ore is a rock or dirt that contains mineralization. And based on this data, 50% of the holes ended in ore, which means that if they were to drill them deeper, in 50% of the cases, there would be more mineralization found. But the reason why they ended them early back then, because that was 30, 20 years ago, even 40 years ago, they were looking for a completely different deposit back then. So this tells me that it is absolutely mathematically impossible for this deposit to be only 6 billion pounds of copper in the ground. It is 100% certainty that there is more. So I am comfortable with the number of 10 billion pounds, and if I use the valuation of 5 cents per pound, this gives me a valuation for Santa Thomas of about 500 million. Now, using this kind of valuation is still not the best method, but it's just kind of cute way for us to getting an idea, and we can play with this number, and we can use, well, let's say we do 2 cents per pound. Well, that's 200 million. What about 10? Well, then if we use 10 cents, then we can get a billion. But again, let's not get too carried away. Let's just use 5, and for now, let's just say that there is a possibility that Santa Thomas could be sold for 500 million. And the reason why I'm saying it's a possibility is because in reality, the mining companies are not going to look at the size of the deposit and just say, oh, we're going to pay you this amount per pound. They're going to use at the cash flow. They're going to look at the cash flow, and that's why it's important for us to look at the cash flow, understand the grade, and how the grade translates into the cash flow. When looking at the data from individual holes or results summarized in the reports, we are bombarded with certain information such as tons, pounds, some kind of percentages like this which represent grade, and it might be easy to get confused, and it's useful for us to understand what these numbers mean in terms of cash flow. So when a company says that there is, let's say, 800 million tons of something, of rock containing some kind of percentage, have this picture in your head. This is how much a ton of rock is. In this case, that would be 5 tons of rock. Okay? So when they say 800 million, it's 800 million times this. okay? And within that rock or dirt or whatever, you have mineralization. And mineralization inside rock does not mean copper, okay? What the mining company has to do is take something like this and turn it into something like this. First, it has to mine it out, transport it, and process it. And in order to do it effectively, it has to build a mine. It has to build a processing facility. And in case of Oroco or Santa Tomas, it would cost as much as $1.5 billion to build the facility that would allow a mining company successfully take out the mineralization from something like this and, you know, turn it into something like this. Let's look at some numbers to see if we can understand how a particular grade translates into cash flow. The first column, we have a 1 ton. What does 1 ton equate to in terms of pounds? 1 ton is about 2,200 pounds. Okay, that's a simple conversion. Now, let's say now that we have a grade of 1%. In other words, within that ton, 1% with 1% of that is copper. Okay, and even though there's 1% of copper, usually you don't recover everything. So let's say a recovery rate for something like Santa Tomas is 90%. Under such scenario, if we multiply this times this times this, this is how much copper we can yield from 1 ton of ore. And if the price of copper is $2.60 per pound, then this much copper yields us this much revenue. And if we know that it costs us $14 per ton to mine it, transport it, process it, then this is our profit, almost $38 per ton. How do I know 14 is the cost? Well, for something like Santa Tomas, based on my research, $14 per ton is a good estimate based on the historical reports and other things that I looked at. So if 37.57 is the profit per ton, look what happens to it if the grade goes from 1% to 0.5%. Watch the profit. It drops to 11.80, okay? Because the revenue dropped from 51.7 to almost $26. And the difference between 26 and 14 is almost 12, right? So that's how grade operates in the mining business. If we take this grade from 0.5% to, let's say, 0.3%, then we're only making $1.47 per ton at the price of $2.60 per copper. Now, what happens if the price of copper changes and it goes from $2.60 to $3? Watch the profit. Then it goes almost from $1 to $4 per ton. Yeah? Let's go back to 0.5 again. And let's use the price of copper of $2.75. Under such scenario, profit per ton is $13. And the next column is a daily production. So for something like Santa Tomas, they could build a processing facility that could process 100,000 tons per day. So that would equate to a yearly production using 350 days of 35 million tons processed per year. So then if we take this number and multiply it times the revenue, then such an operation would generate $954 million of revenues for a yearly profit of $465 million per year. How does this calculation compare to what we have at Santa Tomas? If we go back to this historical estimate that we were given and we look at 820 million tons, okay, and if we just look at this number and we go back to this scenario and we look at a yearly production of 35 million, so if we have 820 million divided by 35, it would last about 24 years. Okay, so we know that. Let's go back. What about the grade? Well, the grade here is we have an average grade of 0.322. So instead of 0.5%, let's enter 0.322%. And today's price of copper is 260. Okay, let's go through that calculation. The revenue that would be generated per ton like this would be $16. The cost would be $14. The profit would be $2.60. Yearly revenues would equate to 581 million, and a yearly profit would be 91 million. Okay, let's say we take that number and we multiply it by 10, we get almost $1 billion worth of profit over 10 years. Now, considering the fact that it would cost about $1.5 billion build the facility, this kind of profit is not very exciting at all. It actually looks like a losing proposition. And that's why when people quickly look at Oroco's grade, they don't get too excited because they see an average grade of 0.3225. In order to understand the value here, you have to look more detailed. If we look on page 13, we were reading these numbers before. 822 million tons at 0.322%. This is exactly what we used in this calculation. And it didn't look too exciting. Now, we have to look into more detail is because this is the total amount and this is just an average. There's no such thing as average grade being everywhere the same. So we have to look into the high grade portion of this deposit, and it's right here. 333 million tons grading at 0.437%. And I know that there's also going to be credits from gold, silver, and other metals. So that particular grade is going to be closer to 0.5%, not 0.37%. But for right now, let's use both of these numbers and see the results. So remember this, 300 million tons and the production is 35 million. So this amount would last for 10 years. Okay? again, let's plug in this number. Instead of 0.32, we're going to type in 0.437%. Now the entire dynamics changes. Now the profit per ton is 8.5. Yearly revenues almost 800 million. Yearly profits of about 300 million. And then if we take this number times 10 years, now we get $3 billion of cash flow. Considering that we have to invest about 1.5 billion, it becomes a more decent proposition. In other words, you generate this much cash flow for the first 10 years and whatever else cash flow from a lower grade material. Now, that calculation is, again, assuming 0.437%. I told you that there is also gold and silver and other metals, credits, which will take this number from 0.37% to closer to 0.5%. Now look at the yearly cash flows now. They jump to 400 million. And now the 10-year cash flow is about $4 billion on this project. That's for the first 10 years. Now, also notice that what we didn't do is I included a copper price of 260. Now, before the coronavirus started and the whole craziness, copper price was $3. And I fully expect copper to be over $3 when things go back to normal. So we can't really use a very depressed copper price during the coronavirus craziness. So if we go back to using copper price of $3, look at the yearly profits. Now they go to 550 million for a 10-year profits of 5.5 billion. Now this project becomes very interesting to anyone, any major mining company. So the idea behind packaging this project and selling it to a bigger mining company is to show and confirm that yes, there is a high grade portion of the deposit grading at 0.5% or somewhere around that would last for about 10 years. So you go to the mining company and you show them, if you buy our project, for the first 10 years you can generate $500 million in profits for a total of $5.5 billion over 10 years. And then once you go through the high grade portion and then you go after 10 years you go back to, let's say, mining 0.32%, then for the remaining 10 or 20 years you get to make $200 million per year. But that's assuming copper price stay at this level. Within 10 years, with all the electric cars, I bet the price of copper is going to go to $4 or $5. So let's say it's $5 in 10 years from now. Then the mining company would be making $400 million per year in profits from a lower grade portion of the deposit, because at that time the low grade of 0.3% would be considered high grade, because all of the copper deposits in the world would have to go lower because simply of depletion. You see, 20 years ago 1% copper was a requirement, but as we depleted 1%, now we're mining 0.6%, 0.5%. That's just simply the maturity. That's how the maturity of mining assets happen over time. How does all of this, let's go back to these numbers here. How does all of this translate into some kind of net present value calculation? Well, I'm not going to do that here because someone else already did that calculation. Caesar's report on September 18th, 2019, if you go to page 17, he calculated net present value after tax. You see, what I was showing you is before tax. After tax, using 8% discount rate, he came up to a net present value of 1.6 billion using the copper price of $3. Very reasonable. Here's all the cash flows. Here is $1.5 billion worth of capex to develop it. And if the price of copper drops to 2.75, the net present value is still 1.2 billion. So going back to this $3, which I think is more reasonable, based on what we know today, not based on the number that, not based on 10 million pounds that I'm saying, or more, or any exploration success, based on today, with of course with a better price of copper, we have a net present value after tax of $1.6 billion. So now the question is, how much would you pay for a project like this if you were a mining company? 300 million, why not? 500 million, why not? Usually projects like this sell for a certain percentage of net present value. So if, let's say, we assume 25%, the project would sell for 400 million. If we assume 50%, it would sell for 800 million. But I think that this project is going to get a lot bigger than what it is right now, and the net present value of 1.6 billion is going to be much higher than that. That's why eventually I think that Santa Tomas will end up selling for $1 or $1.5 billion, because I think that the net present value will grow to $2 or maybe even $3 billion because the deposit will get bigger. In the next video, I will be talking more about the growth of the deposit. What are some of the interesting areas that might make it even more valuable than what it is today? And just keep in mind that this deposit doesn't have to get any bigger than what it is. $1.6 billion of net present value based on historical data, it's fine with me. But I think we're getting bigger. So that's it for today's video.